make sure that fits into your own goals. Like, why are you trying to become a franchisee? Or do you want to buy yourself this job, or are you trying to have multiple locations that provide financial stability for you and your family, right?
You don't have to invest $500,000 to buy yourself a $75,000 job.
Right.
You can just go to work at Olive Garden, become a general manager, make $75,000, save yourselves $500,000 in investments and all the headache stress of running a restaurant. Welcome back to another episode of TechBites. Today we're going to take a second part of our franchisee conversation, and we're going to be talking about what should the franchisee look for when they're evaluating brands on what to franchise. There is no other better expert than our typical speaker, Mr. Kendall Ware. He's been in that space for a very long time, has grown several brands, has been with smaller brands that has gained a lot of franchisees, grown it through franchisee operation, and has been at the helm of Cinnabon and Carvel, managing 2,200 locations and I'm sure several hundred franchisees globally. So Kendall, welcome back in.
Awesome, thanks for having me.
Absolutely. Like I said, there's no better expert in this space than you. So anything I'm learning even as I'm having these conversations with you. So let's dig in.
All right.
I'm trying to go franchise a concept. I want to get into a restaurant business. What am I looking for? How am I looking? Or what am I looking for? What steps should I take? What pitfalls? What mistakes not to make, etc. So you've got a ton of experience in that on both sides. So run us through a little bit.
So it's a very common question that a lot of franchisees have, or prospects who are out there looking around. And I'll say that a lot of the basic things that you need to look for are not talked about enough. So they're basic in the world of franchising, but they're not basic for the average prospect looking around. Most prospects find a brand they're engaged with, they dine there, they enjoyed it, they have some sort of tie to it. So then they think, oh, I should go become a franchisee, I'm gonna go look into this. And sometimes that's great, but sometimes that's also a recipe for disaster, because you're going to something that you may enjoy as a consumer, but doesn't mean you're gonna enjoy it as an owner. And so the things that I would focus on are a little more technical. Once you get into a process, sure, go out there and find a brand you enjoy, find a brand you understand, something you could see yourself being involved in. But after that, you got to dive into the details. So the first thing I would focus on is, once you go through the process with any franchisor, once you get through certain steps and pass certain qualifications of net worth and background checks, credit checks, whatever the franchisor prefers, then you can get the FDD. That's the franchise disclosure document. That's basically the end-all be-all of the franchise brand. It tells you everything you need to know about that brand, the good and the bad. But once you get to that FDD, there's certain items and sections in the FDD that you should focus on. So if I'm a franchisee going to evaluate a brand, the first thing I would focus on is item 7. So item 7, if you wanted to flip straight to that page, item 7 is going to break down all the costs associated with building and owning that franchise going forward. So your operating cost, how much it's going to take to actually build out the units, the equipment costs, technology costs, everything that goes into it will be disclosed. And that's a good indicator to see what you're getting involved in, right? Is this a spend that you can actually maintain? Are you willing to go and invest the $400,000, $500,000, $600,000, maybe millions of dollars to build this out? And get a feel for what that operating capital needs to look like. It's one thing to go raise the money to build it. It's another thing to find enough money to build it and then operate it for the first couple months, right? And the biggest mistake I see people make is they get in, they get the loan, but they don't have any money to actually operate once they open. And then they start to figure out how to cut costs from day one versus trying to grow the business.
Yeah, man, and we always say don't cost yourself out of business.
Out of business, that's right.
Absolutely.
And it happens frequently, right? So item 7 will give you all those details, right? It's going to really dive into it. And if I'm evaluating a franchisor right now, I would ask the question to the franchisor, how much has this item 7 increased over the last couple of years? Because all the commodities have gone up, all the manufacturers have raised prices, there's a lot of delays, and a lot of people are paying extra to get certain goods or equipment. And so it's best to understand what's happening with that amount, and to make sure the franchisor has done their research to make sure that the amount hasn't gone up and they haven't properly disclosed it.
Yeah, and actually that's funny, because last time we talked about on our previous episodes, I didn't even know that, but they have to maintain and update that on a consistent basis.
That's right, yeah.
Otherwise there's some regulations and government entities that can get involved, lawsuits and all that jazz. So on the franchisor side, they've got to be really careful, because that item 7 has probably changed drastically in the last 3 years.
It has for many brands. And it's always going to give you a range. And so you have to understand that range and understand what that low is and that high and why, right? What dictates that large range that you see today? Because some brands have a very large one, some brands have it more dialed in, and some brands will actually do it by model. So if you have a kiosk, here's your range. If you have a non-traditional, here's your range. Full service. It just really depends. But it's good to understand all that information to make sure that you know what you're getting into, and it's something you can see is feasible for you and whatever your financial situation is.
Yeah.
So item 7 is that first piece. Again, it's all build out and operating costs to do business as that franchise. The second thing I would focus on, and it's probably the most important, is item 19. So item 19 is all the financial representation of that brand. It's going to run you through, franchisees' P&Ls. It's going to run you through the franchisor. It's going to run you through everything that's happening financially. But it's good to get a feel for how that profitability is today. Now, this gets tricky, and I've mentioned this before. But as you get into item 19, not all franchises are represented, right? Not all of the operating units today are showing their P&L. It's up to the franchisor.
So they could actually pick and choose who they
can
will
pick and
present.
choose. Within certain reasoning, they can pick and choose based upon model type. They can pick and choose based upon menu and what they offer versus what the standard is. Like, there's a lot of factors, and the more, I would say, sophisticated the brand, the better that information is. So some brands may not actually show all the P&Ls of all the franchisees for a couple reasons. One, it may not be a pretty picture, right? And they're trying to find the best representation of their brand, which they should do, but in a honest manner, right? It shouldn't.
Sure.
It's understandable to weed out some of the underperforming units or the ones they know that they are closing or whatever the issue may be, or maybe it's simply because they know that they're not going to get that information from the franchisee, and that's more of a compliance challenge on the franchisor's behalf. But for most cases, not all the locations are represented in that item 19. So just know that whatever snapshot you're seeing is not a full representation of the entire brand. And so you'll get to that information later on in another topic, but it's best to understand that, look at what the profitability is, make sure that fits into your own goals. Like, why are you trying to become a franchisee? Or do you want to buy yourself this job, or are you trying to have multiple locations that provide financial stability for you and your family, right?
Absolutely, and actually that brings it to a very close thing that I constantly say is, you don't have to invest $500,000 to buy yourself a $75,000 job.
That's right.
You could just go to work at Olive Garden, become a general manager,
Sure.
make $75,000, save yourselves $500,000 in investments, and all the headache stress of running a restaurant.
That's right.
So that is very critical.
Yep.
And this is a great point that you brought on, because it's the unknown.
Right.
I didn't know that item 19 is not a representation of the entire brand. I figured it was.
Sure.
You just assume that it is. So the things you don't know is what's going to really impact you big time. Because you may end up in the situation that you invest $500,000, $750,000. You bought yourself a $75,000 job, and it's like, oh,
that's right.
What did I get myself into now?
That's
and it's too late, and now you're on the hook.
Now you're on the hook for a minimum of 10 plus years, right? Depending upon the agreement. So it's so critical. So look at the gross revenue numbers, look at the EBITDA that they're disclosing, and just understand what the averages are, right? Some franchisors will break it down into certain categories, showing you like volume bands, and if you're in this volume band, here's your average EBITDA. It's just lots of stuff that you just need to digest.
Sure.
But ask all the questions imaginable to that franchisor to make sure that you can truly understand what it's saying. Now, you would want to be careful of asking certain questions. So for example, if you're asking the franchisor more detailed questions around financials and it's not disclosed in the FDD, it may be good for you to get that answer, but it's usually a bad sign that the franchisor is not following FTC regulations and the rules of franchising, because they might just be trying to sell you, so to speak, on other wins or other financial that are not disclosed, right?
Yeah.
And so you want to watch out for that. Some franchisors might start throwing all kinds of numbers at you to show how good you're doing, but if it's not listed in the FDD, don't take it as actuals.
Yeah, because they could say anything, but on that FDD document, it's a governance that's controlled through some sort of a agency, government agency.
Yeah,
and I think it's controlled through
FTC,
FTC?
Federal Trade Commission.
Yep.
And the franchisor can say all those things. It can get them in trouble, actually. Like they're not supposed to do that. They're supposed to only speak to what's in the FDD.
Yeah.
So just signs to watch out for on the franchisee side. So item 19 is critical. That's usually the tell-all be-all of a franchise, because that tells you whether it's worth investing in or not. Now, I still recommend reading the FDD cover to cover, right? You should do that, but these are just certain areas where you can hone in pretty quick to help with your evaluation process to weed out some of the bad apples.
I wonder how many people actually read through that FDD cover to cover.
I know I do, but I don't know about anybody else.
Yeah, I don't know. Like, how big are these?
It's
FDD
about 350 pages.
Oh wow, yeah,
so
good. Like, that's
most
like
people,
a book.
Yeah, most people are overwhelmed. They say, forget this, I'm not going to read that. And so if you happen to be one of those people, maybe you're not ready to read all the FTDs right now because you could be evaluating 5 to 10 brands, but skip to these items real quick.
Yeah.
Do quick reviews, get your questions, and then when you find the couple you like, then go and read everything to make sure you're not
I have a better
missing
idea.
it.
Just call Kendall, say, hey Kendall, read this 350-page book, tell me what to do. Yeah.
All right,
Feel
I'm
free
here
to
for it.
contact him and have him, hey. And actually you do some consulting
I do
as
that,
well.
I help
so
out
you,
franchisees all the time. Yeah.
And franchisors, so you're on both sides, so you
right.
really clearly understand both sides of the
right.
equation. So
I stay very close to it, and I've served as a franchisee, served as a franchisor. That's where my passion is, so I stay very close to it.
Absolutely. And actually, so the initial conversation that you said, so obviously I was a full-time day trader.
Yeah.
And I remember one time one of my, he was a trader as well, really good friends. And I don't know what we were doing. We were walking upstairs in the Barnes and Noble and we were talking about trades and stocks.
Yeah.
And I'm like, you know what, this would be a great company to buy. And he's like, why? And I'm like, well, I mean, just look at the business. Like, I come here all the time, so
Sure.
like I assumed it was doing really well, etc.
right.
So back to your point, you don't just go out there just because Starbucks is your favorite coffee shop.
right.
It doesn't mean you go buy their stock because they're a great business model.
No.
It just doesn't work hand in hand.
Right.
So back to your point of, you don't just go to XYZ sub shop and then you're like, oh, I love this. I spend a ton of money in here. I should buy a franchisee.
Right, right. But that happens a lot. And in fact, one of the brands I led, it was 80% of our franchisees became franchisees because they were guests of our location and loved it so much.
Yeah.
Now, that's a great thing for passion. It's a great thing for like engagement and excitement in the brand, and it builds a culture. But that doesn't mean you're getting people who are skilled as franchisees.
Sure.
Right?
Yeah.
And so it's a balance. You can teach a lot of those skills, but at the same time, you have a lot of business acumen challenge that come with that. And usually the money doesn't get managed appropriately to where there's a lot of closures or just downside that comes with it, right? So it's just the balance of the franchisor that you have to manage. But to your point, you know, you see these brands that come out and they come out of nowhere. They have a couple locations. Those locations do well. It's high quality food, and you see them sign on hundreds of franchise agreements.
Yep.
And this is usually where the trap happens. So as a franchisee who's looking for an opportunity, you might see, oh wow, this unit or this brand just opened 100 locations last year and they signed another 200 agreements. I want to go get involved now before it's too late. And it creates that urgency, but usually that's not a brand you want to get involved with unless these other metrics are actually adding up. Is item 19 actually proving itself out, right? Is it too early in the process to where the model's not even proven yet to where you shouldn't even be considering it, right? So sometimes those fast growing concepts are actually the ones to stay away from. But it just depends. It depends on how they're truly performing.
Got you. Yeah, and actually that brings up a point because if there's no history, then
Right.
yeah, it may be doing well and it may do well for a couple of years, 3 years, and then the fad goes away, and then here you are stuck with a 10-year agreement.
That's right. Yeah. So item 19, again, financial representation of the brand. So there's 5 key things I would look at when evaluating a franchise opportunity. Now, there's many more than that you'll get to eventually, but there's 5 key ones you can do initially just to help you weed out some of the process and really get a feel for what brand you're getting engaged with. So we covered 1, 2, but so the third thing I would evaluate.
Actually, just to kind of set stage. So item 7,
Okay,
item 19.
So the first thing I would evaluate is item 7.
Yeah.
Right. The true build out cost and operating cost of that franchise.
Sure.
The second thing I would evaluate is item 19. That's the financial representation of that franchise.
Got it.
The third thing I would evaluate is item 20. Item 20 is going to give you the snapshot of how many locations have opened and closed in that year, and a couple of years back, I think it's a 3-year run rate, but it's going to show you the open and close rate. It's going to show you how many units are being transferred or have been transferred, which is another sign to look out for. So if you see a bunch of franchise restaurants have been transferred to other franchisees, you need to find out why. And maybe you're reaching out to those franchisees and just asking them. Maybe you're asking the franchisor and hoping they give you the full transparency there. But that is a question mark. Sometimes it's for the right reasons. I've transferred out of a 200 location brand. I once transferred out 80 locations because we just didn't have the right mix, right? We had a lot of investor-based franchisees, but not operator franchisees.
Gotcha.
And our brand required an operator to be on site, to actually work the business versus thinking they could pay somebody a salary and stay absent from the business and still make money. It just didn't work that way.
Sure.
So those were good transfers, and it was going
Sure.
towards the future vision of the brand.
So
but
that's item 20 on that one too.
This is all item 20.
Okay, yeah, all
So item 20 will show you current restaurant or store count. It'll show you number of franchise units versus corporate units, the transfer information, basically everything you need to know about the locations themselves, as well as a franchisee contact list. And this is where it gets interesting. So as a franchisor, they should never tell you who to call. Some might because they may be nervous, but that's still crossing boundaries.
Sure.
So as a franchisor, you're just supposed to provide the list, and it's up to the franchise prospect to reach out to the franchisees. Okay?
Got it. So they actually do provide you the contact information.
Yes, in a lot of cases, they'll actually also share those who are no longer franchisees of the brand.
Oh.
So I'd find that list, and I'd go reach out to those people if that exists in that brand. But as doing your own due diligence, I would call 20, 30, 40, however large the brand is, get a good chunk of that. So maybe it's 50% of the brand, 60% of the brand. Reach out to as many as you can. Some will take your call, some won't, but call them, ask questions, right? And really drill them to make sure that you're not trying to find dirt, you're trying to just make sure it's something you can sustain. Like you're
Sure.
comfortable with whatever they say the problems are, the opportunities, the day-to-day struggles, like get a feel for what that is. But the question you should ask as franchisee is ask the franchisor who's on your FAC, who's on your franchise advisory council, or any other committees you happen to have that are made up of franchisees. Ask them those names, because usually they're not going to tell you those names because they're not supposed to, but ask those names, get them, and of course call those people, but know that when you're calling the FAC members, they're going to probably tell you a better story. Because usually FAC members are made up of people who are engaged in the brand, they're passionate about it, they have a voice in the community, and they're trying to impact change. So that's usually a more positive conversation. Should be.
Sure.
But that doesn't mean that that's where you should end. You want to have that balance with the guy who closed 2 years ago, right? Or whoever's disclosed in there, the one who's transferring in a couple months. You just want to get an overall sense of the community. And so that's really item 20. Now, FDD aside, there's a couple other areas that I would focus on. So that's the first three. The fourth thing is I would ask for an org chart, like what their current organizational structure is and overall headcount, and I would ask for it for the last 3 years. The reason I do that, and this is not a common thing to look at or ask for, so franchisors may be a little confused by this, but you want to get a feel for where this brand is headed. You just reviewed item 20, and item 20 showed you basically the store growth or restaurant growth and or decline. And so you have a pretty good understanding of what's happening. Maybe it's going up, maybe it's going down, but what's happening to the headcount? And if the headcount is going down faster than the locations or it's not correlating to the growth, you might be in a situation where you're not going to have the support that you actually need to be successful.
I see.
Because some franchisors, depending upon their royalty rates, their ad fund, and other fees they charge, it may not be enough for their P&L to sustain a strong enough team to actually support the demands of the business, believe it or not. And as a franchisee, you may go look out for these more affordable royalty rates, but if I'm a franchisee, I'm going to stay away from the brands that have a low royalty and ad rate, because that means they don't have enough funds to properly support me or grow this business.
I see. That's actually very interesting. Never thought about that, because everybody naturally just says, hey, I'm going to go after the most affordable one.
That's right.
And discount the ones that are actually trying to help you build a company, build a brand, etc. So I like, this conversation has come up even internally within our own company, and I'm like, look, the people that I pay the most attention to are the ones that help me take it to the next level.
That's right.
That help me get more customers, get more sales, improve business, grow top line revenue.
That's right.
So I guess that applies also over here, because if they're taking that fund and they're helping you in a local market, because once they help you increase revenue, then that's amazing. Like that's priceless.
Right. And that is a common mistake. And so be cautious of the franchisors that are having these advertisements of zero royalty
for 36 months. I've seen that.
No royalties
actually,
for a year. It sounds attractive, and it's going to save you on your bottom line, but that means they probably don't have a strong enough infrastructure to support a franchise network.
Yeah, that's a red flag.
Yeah, keep that in mind, right? You want to make sure that it has to be reasonable, right? If a franchisor who has 20 units is asking for 20% or 10% that's insane. And people have tried. But look at whatever this brand is, whatever type of franchise it is. Go look up similar competitors or whatever's in that industry. Is it casual dining? Is it more specialty brands? Is it ice cream, frozen yogurt? But go look at other franchises and what is their average royalty rate? Is this brand at least at parity right? Or maybe even a little bit higher than those brands.
Plus or minus a couple of points,
right.
maybe.
That's okay. But if you see a brand that's way off, like let's say the average specialty concept has a 5% royalty rate. Okay, that's great. If the specialty concept you're evaluating has a 3% or a 2% royalty rate, okay, there's a problem there. Because one, that already tells you, guess what? Your competitors are better capitalized than this franchise you're evaluating because they have a stronger royalty rate,
Gotcha.
right?
Yeah.
And same thing goes for the ad fund and any other fees they have. And so you need it to be reasonable. You need to see the potential of making money out of this franchise, but you want to make sure that you're not, basically costing yourself out of business again, right?
Yeah.
Not having enough funds. And if the franchisor can't support with headcount or systems or services from their own P&L or their ad fund, then it's not going to push the brand forward.
Gotcha.
Okay?
And then the fifth topic?
Well, real quick on the org chart though, I would go into this a little bit deeper. You want to look at trends of each department. So look at the levers that actually drive the business today. We all know technology is one of the largest components of business now. Technology feeds every other function and department in the business. So what does a technology team look like? Some brands who are accustomed to the past and they have not adapted to the future might only have 1 or 2 people in technology.
Interesting.
And that's not enough,
Yeah.
right? And then you want to look at marketing. That's another key player in today's world of how we're actually going to build brand awareness and drive revenue and traffic to the business. And then, we look at every department. Of course, on the operations side, what does that franchisee support look like from a franchise business consultant standpoint, or whatever your regionals are called? But just get a feel, like, do you feel like it is adequate enough for the size of the franchise that you're getting into? Okay, so org chart's one. So the fifth thing that I would look at, and this is a critical one as well, and this gets in a little bit into the weeds, and some franchisors may not feel comfortable, and or they may not even have the answer, but as a potential franchisee, you have the right to ask this. But when you're looking at an ad fund, so the ad fund is mandated by probably every franchisor out there. All those funds that are raised, which is a percentage of the franchisee's gross and or net sales, all those earnings go into a fund. That fund has to be spent on some sort of media, marketing, advertising for the brand. The franchisor spends that on behalf of the franchisee, okay? So every year they're supposed to spend majority of that. It's common to have a little bit of leftover just to reinvest in the beginning of the next year or whatever it may be. But majority should be spent, and so you want to understand what that looks like. How have they been spending those dollars today? And it's okay if it's just high-level categories, but the big question in all this is what percentage of your ad fund is being allocated to headcount? Because
I see.
As a franchisor, you have the right to allocate marketing headcount to the ad fund.
I see.
Meaning the ad fund can pay for an entire marketing department of 20 people if it can afford it. That is great for the franchisor. That is obviously great for the franchisee if it can support enough headcount for you. But the bigger question is what happens if it's majority headcount and not enough working dollars to actually grow media, build brand awareness, do campaigns, launch new menus, whatever is going on in that brand.
So like having too many chiefs, not enough Indians.
Right, and you'll hear this a lot. You'll see a strong marketing team, best of the best talent, but they complain about not having a big enough ad fund to actually grow the business.
Sure, yeah. I mean, yeah, you can. It has to be a mixed balance.
Right.
Very interesting.
And there's some crossover with technology these days, right? So some roles that are in maybe loyalty and digital. Sometimes that's on the technology side, sometimes it's on the marketing side, but you'll see some of those roles sneak into the ad fund as well. And so again, it's up to the franchisor. It's their right. But just ask the question. You're not questioning the franchisors, you're asking questions. It's a big difference. Yeah. But you want to understand what you're getting involved in. Are you getting involved with a franchisor that believes in having, yes, the right amount of headcount, but more working dollars? That's probably better for you. Or are you with the franchisor that believes in having the best of the best talent, paying top dollar, but just doesn't have enough left over, right?
Yeah, because at that stage you don't have any fuel. You've got the most incredible car, you just can't afford the fuel, you can't afford the maintenance, you can't
sit in the
afford any
driveway.
of it. It just sits on the driveway. Why?
Right.
So it just kind of defeats the purpose. You got to balance it out. It's not just, you have to have the chiefs, but you have to have the individual contributors that actually move that forward, and you have to give them the right tools to make their job feasible, right? You can't expect them to create something out of thin air.
But that's the top 5 I would evaluate. But at the end of the day, what are you trying to accomplish as a franchisee? Do you want to buy yourself a job? And that's okay if you do. But do you want to buy that job? And is that where you want to work because this is just your plan? Or are you trying to build something of future wealth? Are you trying to actually build stability, right? And what kind of franchisee are you going to be? And make sure that whatever the answer is aligns with the franchisor. Are you an operator or are you an investor? Are you going to be engaged or are you going to be passive?
Sure.
figure that out first, and then find a brand that can support you, and make sure your why of being a franchisee is clear for yourself. Again, don't go chase a shiny object. Don't go chase the brand of the year. Really ask yourself why you're even considering this, and then make sure you can get the right capital structure or investors to support the ongoing operation of that business. So.
Yeah, that makes sense. Because also, like, if you're trying to grow, then you don't want to go into a 50-unit brand and own 40 of them and become, bigger than kind of that franchisee, because they only have 1 or 2 stores of their own, etc. So I've always wondered how they're doing that. It's like you only have 1 or 2, one store, you don't even have a store. You're not even on operation, and you're making decisions on these operation things that is impacting the franchisee.
Now that's a whole other topic we could dive into, but on that note, like, it depends upon where the brand is in their life cycle. If they are an emerging brand, there should be at least 3 to 5 corporate units being ran and proven out. Now, if you're a larger brand, like when I was at Cinnabon, we had 2,000 locations, but only 1 corporate location.
Well, but that makes sense, because we've
already
proven
it out.
Yeah, exactly. I mean,
and in fact, I ended up
models.
selling that last corporate unit to a franchisee nearby, because you got to ask yourself as a franchisor, what business am I in? Am I a franchisor or am I a corporate operator?
Yeah.
We're a franchisor. So let's just keep our focus and our team aligned on the overall mission of supporting our franchisees and helping their revenue grow. But it just depends upon the brand's life cycle. But that is a good point as a franchisee. Make sure there's at least some proven concepts corporately, and that they are in the same business that they're asking you to invest in.
Absolutely. And I think that technology plays a huge role, because even internally we're talking about kind of this division of ours that will go under like Milagro Capital, and our core competency is going to be the technology.
That's right.
And I think the brands that don't adopt that technology, they don't go after utilizing technology to elevate the customer experience, now the employee experience, based on our previous topics with Pankaj saying, hey, customer experience is critical, but so is employee experience.
That's right.
And if they're not feeding that, and they're not utilizing the latest, not the latest, but the technology to move that forward, then you may not want to be there.
That's right.
And you don't want to have to figure it out.
Right. Item 7, and looking at the ad fund spend and org chart, all that's going to point in that direction as well. Like, are they actually investing in technology? And look for a tech fee. Tech fee to you as a franchisee might sound like more money to the franchisor, but it's not. A tech fee is going to help a franchisor get the best of the best technologies and keep reinvesting and or testing new services. And again, if there's a fund to do that, similar to an ad fund, that's a good thing for a franchisee.
Sure. Yeah.
But again, if there's not the headcount that supports it, or the strategy and the headcount that you see on org chart keeps going down, again, you may not be talking to the right franchisor.
And ultimately, I mean, I look at it, the difference between going franchisee and opening your own independent is the support, is the technology, is the marketing team, is all the back-end support that you get.
That's right.
Versus you go do it yourself and have to figure it out. So if you open a franchisee and you have to go figure it out, then do your own independent brand and don't even bother. Why?
Right.
And there are brands out there. Actually, I know a brand that has like 130 units, and it's free for all. Here are the recipes. You go figure it out. And it's like, why would I open this brand again? Like, there's no support from the franchisor.
Right. Let me hit one more thing, but we'll have to remember to bring this back and put it in item 20. So also in item 20, the other thing that you would want to look at is how spread is this franchise. So when you're looking at their breakdown of how many locations they have in each state, if they have 1 location here, 2 locations there, and they're just spread across the U.S., that's another challenge, red flag I would look for, because that means that your supply chain and overall distribution may not be that dialed in. And it may not be you may not be able to leverage buying power yet because you're so spread.
Gotcha.
The brands that are selling out territories and saying, hey, we only have 2 spots left in the state of Washington. Okay, that's a good sign. That means they've been strategically filling out a state, and they already have other franchisees there, which means they're going to leverage their buying power, leverage distribution, supply chain, and it's going to be better for you in the long run. But I know many franchisees who pay a premium on top of a premium to get certain goods and services because of their location and being too far away from the hub. And so the franchisors that are growing and they're emerging, it's more strategic and safer to do it in a certain region, right? And so get a feel for that with the franchise you're evaluating, just see what they're doing so far and what their strategies have been. And it's okay if they didn't start that way, but whoever the leadership is now, are they thinking that way to go
make sure
forward,
there's a roadmap to get there, because food cost is
It's only going up.
It's only going up, but it's a third of your cost. So if they don't have the distribution in place to make sure that you get the best pricing, because they have to get delivered, and it's going to have a 5, 6, 7, 10% cost increase, that's going to make a huge impact.
That's right.
You're going to have to do so much more.
Okay.
All right, thanks everyone for tuning in. Kendall, thanks for being here. A lot of interesting topics. Again, I'm just sitting here soaking all this in because I didn't realize it's a 350-page book anyway to read this documents. But thanks for the insight. We hope that everybody, you found a lot of useful information in the topic of today. And if you're looking at franchising, obviously do your own due diligence. If you need any support, assistance, feel free to reach out to Kendall.
Absolutely.
How do they get a hold of you?
Yeah, definitely take your time evaluating the franchise. Find me on LinkedIn, find me on Instagram. That's the best way to connect with me today. And we can go from there, but happy to help any way I can.
Awesome, thank you.
Yeah.